One group of stocks did almost all of today's damage. The 7 largest technology names, the ones that have carried this market the whole year, just logged their worst single day since the spring of last year, and they threw off roughly 3/4 of every hedging dollar that moved through the index. This is the Algo Index market close for Thursday, the 23rd of July. And here is the odd part. For all that violence in the biggest names, the index they lead gave back only about 1.5%, closing at 7,408. It sold hard, then it stopped. And where it stopped was not luck. The low of the day, 7,376 at 11:35 this morning, printed 6 points above the precise downside the options market had already drawn before anyone traded a share. The single stocks broke. The index obeyed its own math. 3 things worth staying for. How does a market lose this much in its biggest names and still close in an orderly way? Who put down real money today, betting volatility goes far higher than it just did? And did our own desk read a falling market right, or get run over by it? Answers in that order. The board first. The S&P 500 closed at 7,408, lower by about 90 points, 1.5%, its sharpest single session in roughly a month. The Nasdaq 100 fell harder, more than 1.5%, the worst day for the megacap group since the spring of 2025. The fear gauge jumped more than 12% to 18.69, and its own volatility index climbed near 102, both of them telling you demand for protection is building, not fading. The full range on the cash index was 74 points, right around 100 basis points. Puts outran calls, open interest near 1 3/10 to 1, and 1-month implied volatility sat near 13 against realized near 9. So protection is bid without being priced for a crisis. Put those readings side by side, and you get a market selling off with intent and hedging into the move, not one coming apart at the seams. 2 shocks hit together, and each one made the other worse. The first was a scare over spending on artificial intelligence. Alphabet fell about 7% after it raised its capital budget for the year toward $205 billion, more than double last year's, and investors punished the size of the bill instead of cheering the ambition. Tesla dropped about 16%, a profit slide paired with its own spending surge. That is the whole megacap complex getting re-rated on one worry: whether the enormous outlay on AI will ever earn its keep. The second shock was oil. Crude ran more than 6% above $90, now about 28% higher than it was at the start of July, on hardening conflict risk in the Middle East. Rising energy costs undo the cooling inflation story that had been holding growth stocks up, which is why the names that led the rally were the ones that led the fall. Underneath the price, the selling was concentrated and deliberate. About $4 billion of net equity selling landed in the first 90 minutes. Then the pace flattened, and the desks doing the hedging were selling their longer-dated upside while buying downside puts, trimming exposure and paying for insurance at the same time. A dispersion measure jumped as traders reached for index-level protection and sold single-stock volatility, the signature of hedgers bracing for the kind of move that pulls everything down together, not one name at a time. Stay with me here, because this is why a brutal day in the biggest stocks came out orderly for the index. Before the market opened, the options implied one-day move low sat near 7,370 on the cash index. Nobody publishes that as a prediction. It is the downside baked into what a single day of movement cost to buy that morning, and it was already there ahead of the open. Now, watch what price did against it. The index came in near 74.18, popped to its high of 74.50 at 9:45, then rolled over and bled lower for 2 straight hours into a low of 7,376 at 11:35. 6 points. The session bottomed 6 points above the number the options market had drawn hours earlier, and same-day put selling carried it the rest of the way into the close at 7,408. There is a catch worth your attention, though. The dealer positioning that usually buys these dips is still positive on paper, but the cushion has floated up to about 7,580, roughly 170 points above where price closed. The stabilizer is no longer sitting under the market. It is parked overhead. The level that matters underneath is 7,300. Hold 2 numbers going home. 74.80 above is the decision line, and 7,300 below is where this gets faster if it breaks. Now the money. The loudest options positioning of the whole session was a wager on fear itself. Somebody bought about 52,000 volatility index calls struck at 35, expiring in August, and stacked on roughly 16,600 more at 23 for September. These were opening positions, not somebody closing out. Here is the context that makes it land. The fear gauge closed today at 18.69, already up more than 12%. And this buyer is reaching all the way up to 35, a level you only touch in a genuine scare. On the single most volatile day in weeks, the largest volatility trade of the day was a bet that the real spike has not happened yet. One more read before the desk for the options traders. The pricing tells you something the index level cannot. 1 month implied volatility is near 13% against realized near 9%. So protection now costs more than the market has actually been moving, but still nowhere near a crisis price. Skew, the premium paid for downside over upside, is elevated and not extreme. And on the Nasdaq proxy, the implied volatility rank has climbed to about 62%, up in its higher range. The plain translation, hedges get more expensive by the day, and the cheap window to have owned them was last week, not tonight. Our desk, plainly, 3 trades. 1 win, 1 loss, 1 break even. The win was the easy one to describe and the hard one to hold. We were short with the trend, and we stayed short while price tested the level 3 separate times and failed each time, and the target paid on the touch. We did not bail on the wiggles, because on this design, the bounded premium is the only stop, and letting it do its job is the entire point. The loss and the break even came from the other side, fading the afternoon bounce. Buying a recovery in a market that wants lower is the hardest trade there is, and we have the scorecard that proves it. 1 clean trade with the move, 2 harder ones against it. That is an honest day, and it is exactly the shape a trend down session tends to hand you. Into Friday, the lean is cautiously lower, with 2-way risk, and it hinges on 2 numbers. Above, buyers reclaiming 7,480 would turn the tone back toward constructive. Below 7,300 is where this speeds up, because the same-day put selling that softened today's decline expires tonight, and without that cushion, the swings can widen. The calendar is thin. 1 first-order item, the flash purchasing manager surveys at 9:45, with American Express and Verizon reporting before the bell. The heavy week is the next one, a policy meeting Tuesday alongside Microsoft and Meta, and growth data the morning after. A word on ourselves, because we owe you the follow-through. Last night we flagged the desks quietly buying protection under a flat market, and said that timing would look smart soon. Today it did, when the very names they were hedging against cracked this market open. We will take that read. What tonight does not settle is whether this is a 2-day scare in a few large stocks, or the front edge of something that needs 7,300 to answer. And no options model priced the risk of the fresh oil headline landing over the weekend. Watch where the low stops tomorrow. Before we go, 3 things that are yours to use. Our trading journal is free, and it is blunt with you. Give it a single trade, and it scores your fill against the quotes that were actually live the minute you entered, not the number memory gives you back. That is at members.algoindex.com/auth/signup. Every level I walk tonight gets scored in the open, win or lose, and that public record lives at algoindex.com/tools/gamma-level-accuracy. The written work is at algoindex.com/blog, and the community runs on Discord, invitation only. Leave with the one number that ran today. The options market drew a downside line at 7,370 before the bell, and the session stopped 6 points above it. Tomorrow, that same math gets tested again, and either it holds, and this stays a controlled pullback, or it gives way, and 7,300 becomes the whole conversation. We will be watching that line right there with you.